The Federal Reserve Bank now says that the coming recession is canceled. Let me read you a statement directly from the Federal Reserve Bank. They said that, quote, the staff now forecasts a noticeable slowdown in growth starting later in 2023, but given the resilience of the economy recently, they are no longer forecasting a recession. This now came out in July 2023, but let's contrast this from what the Federal Reserve Bank was saying in April of 2023, just a few months prior. The Federal Reserve Bank put out this statement, quote, the staff's projection in March included a mild recession starting later this year in 2023 with a recovery over the subsequent 2 years. So in April, the Federal Reserve Bank was saying that we're going to see a recession starting in 2023 and that 2024 is going to be a slowdown, the recovery, and 2025 is also going to be a slowdown, that recovery from the recession starting in 2023. And the reason why this is so interesting is because when the Federal Reserve Bank now put out this statement saying that there's no more recession coming, they also put out an interesting statement about the job market. Now what they said is, quote, the labor market is still out of whack and that can contribute to inflationary pressures. Now, the question is, why is the labor market out of whack and what does that mean and how is it impacting inflation? Well, what they're saying is that too many people have jobs and too many people are seeing raises at their jobs. Now, you might hear that and say, Jaspreet, it's not a very nice thing to say. I like my raise. Well, let me read you what's going on. Of course, higher pay is good for workers. And for the first time in the post-pandemic period, data shows inflation-adjusted wages outpacing inflation. But a rapidly rising pace of wages increases concerns with the Federal Reserve Bank because it is linked with higher inflation. Businesses will raise prices if they believe their customers have more money to spend. So, what does this mean? People are seeing wages go up, but higher wages mean higher prices for goods. So now let's put this all together. By the way, I want to give you a quick reminder that on August 15th, I'm hosting my first ever investor summit. August 15th of 2023 is the 52nd anniversary of the dollar being taken off of the gold standard. And what I'm going to be going over on my live investor summit is, number one, how our economy has changed. Number two, how our money has changed. And number three, how you can use this information to now capitalize on investment opportunities in our economy today. This investor summit is completely free. So if you would like to join me, I'll have the link for how you can join me in the live investor summit down in the description below. If you'd like to join me, just make sure you register because we have a limited number of people that can join. Our software has a limit. So hope to see you there. Now jumping into things, let's talk about inflation, because inflation is, well, there's more money out there, which means more people and businesses have ability to spend. When you have more money, you can go to places like Lululemon, Chipotle, Sweetgreen, and you can spend more money, which is good. You got more stuff, right? But the impact of that now is if everybody's buying more things, that eventually causes the price of things to go up. And you can think of it in terms of, well, Rolls Royces. If everybody had $500,000 in their pocket today, what would you see? You'd see a line around the door for a Rolls Royce. Well, what is going to happen? Rolls Royce can't make a Rolls Royce for everybody. So they're going to increase the price of the products. Now, there's a big kind of supply chain issue that goes along with that, because then the Rolls Royce is going to need more employees to build the cars. They need more employees to sell the cars. They're going to need more materials. And that's what contributes to the higher prices. But you see this happen across the economy. And so when the Federal Reserve Bank says that the labor market is out of whack and how it contributes to inflationary pressures, what they say is, or what they mean, is that the unemployment rate is still too low. And I just put out a video yesterday talking about this, but what they mean is that the unemployment rate is too low. And so when they raise interest rates, one of the things that they're looking for is a cool down in spending, which means also people's incomes on a broader level falling. Now, that doesn't necessarily mean that your salary goes from $60,000 to $50,000, but what that means is that people have less job options. Because what's happening right now in this very tight labor market is that somebody can quit their job and say, you know what, I'm just going to go somewhere else and get a job with a better pay. And if people can just hop around and get higher pays and keep seeing higher wages, it's good for the consumer. This is what the second statement that I read you said, that higher pay is good for workers. But the Federal Reserve Bank is saying, well, if people keep getting higher pays, if people keep getting more money, they have more ability to spend. They also have the ability to get more debt because banks look at you as more creditworthy. And because you have more spending ability and more spending power, people are spending more money. And because people are spending more money, it's contributing to higher inflation. And because we have higher inflation, well, that's the reason why the Federal Reserve Bank is raising interest rates in the first place. So this is where now you can start to put it all together. And I know this can make some people very angry. I'm here to just tell you what's going on. The Federal Reserve Bank wants to cool down inflation. Has inflation fallen off of its highs? Absolutely. But what you keep hearing the Federal Reserve Bank say that, number one, the difficult part is going to bring inflation all the way down to 2%. Yeah, we've seen headline inflation fall to around 3%, but the Federal Reserve Bank is saying to get it from 3 to 2 is still a ways to go. And secondly, keeping inflation down is the second big concern. And this is where the Federal Reserve Bank is monitoring not just inflation, but also the job market. Because if the job market continues to stay tight, if employers have to keep raising wages, well, eventually employers are going to have to raise the prices of their products. Now, there's people talking about they have to raise the prices of their products because people have the ability to spend. That's one part. But the second reason is because if their costs keep going up, well, you have no choice but to raise the price of your products, because if you have your costs rising by 3 to 10% or 20%, whatever it might be, and it's not just because people have higher wages, it's also because borrowing costs are also higher. So if businesses have higher costs, that also pushes them to raise their prices. So if businesses have to raise their prices, well, that also pushes, well, more inflation. And this is where now the question is, what do you do about this? And I've talked about this a number of times, but let me highlight a few things here. Number one, 2023 is not the year for you to go out and finance a new truck. 2023 is the year for you to get financially smart. The Federal Reserve Bank says that there's no recession coming. The government says that there's no recession coming. And recessions generally don't happen when people expect them to happen. However, what we do know, and let's not make any predictions, let's just talk about facts. What we do know is that recessions happen. In fact, recessions have happened pretty much every decade in the United States for the last century. The longest period that the United States has seen without a recession was after the 2008 crash and before the 2020 pandemic. And when the 2020 pandemic happened, it was a so-called, essentially a depression, the worst crash recession since the Great Depression. But really nobody felt any real economic pain if you were getting subsidies, unemployment, stimulus, PPP loans, grants from the government. So we had this economic slowdown, which really wasn't a real economic slowdown in 2020. In addition to that, the second fact that we know is that higher interest rates cool down the economy. Why? Because higher interest rates mean you have to pay more money to spend money, and it cools down spending. Well, between 2020 and now, we have seen interest rates go from the lowest levels in the history of America. In 2020 and 2021, we had the lowest interest rates ever. We went from the lowest interest rates ever to now the highest interest rates in the last 20 plus years. There's going to be an impact for that. We don't know exactly what that's going to be, right? We can't predict that. We can make guesses. We can talk about the impacts of higher interest rates, but we're going to see the impacts of that in the coming years. Third, what we also know is that we have the highest debt burden in our country, not just from a government perspective, but from a business perspective and a consumer perspective and the government perspective. So our government, corporations, and consumers have the highest levels of debt in the history of time. And most business and government debt is not 30-year fixed rate mortgages, it's readjustable debt. So if interest rates stay high, that means debts will readjust at a higher cost. These are the facts. There's going to be consequences to all of these things. Now, why do I say 2023 is not the year for you to go out and finance a new truck? Because, well, it takes time for everything to kind of play out. Everyone's expecting this massive click of a button, things flip in the economy, but that's generally not how it works. You see a buildup, people start to get anxious, people make money, people don't want to wait, and people just keep throwing their money around. But this is where you want to be using your time to get financially smart, because there are 100% red flags in the economy. That's a fact. When will we see the impacts of all the debt, the higher interest rates in our economy? Nobody knows that. But we know that in 2024 and 2025 and 2026, a lot of debt is going to be readjusting. So if you can now use this time as an opportunity to get financially educated and to get prepared, meaning put money aside to protect you against an emergency, put money aside to have money to invest, and also learn how to invest, you're preparing for really anything. And it's not a matter of doomsday and saying, oh, the world is going to end. No, that's not what we're saying. America is still the greatest economy in the world. It's the best place to be in the world. It's the best place to invest your money in the world. 100%. Yes, there are concerns with the dollar. Fitch downgraded the United States. Obviously, there are concerns happening. Obviously, there are economic concerns, but where else in the world would you want to be? But your job as a financially sound and a financially educated person is to be prepared for anything. And that's what being financially educated and prepared is about. It's not of living this life of saying, oh, are we going to see a recession or are we not going to see a recession, and panicking about the idea of a recession. Wealthy people love when a recession happens, and savvy investors love when a recession happens because it gives and creates investment opportunities. And so what you need to do is understand, well, everybody's talking about if and when we're going to see a recession. The reality is we will. We don't know when, but we will. We have seen it happen every decade over the last century. So you should prepare. Plus, we have so much debt in our economy today that when the next downturn happens, you have to expect that these higher debt levels are going to create more issues. I mean, in general, what we've seen over the last century is the bigger the bubble, the bigger the burst. In 2008, we had a lot of debt out there, which is why it was such a big bust. 2000, when the dot-com bubble bursted, there was a lot of debt out there, which is why it was such a big bust. Today, we have more debt than ever. And it's not a problem until it becomes a problem. And what you want to do is not prepare when it becomes a problem, but rather prepare when times are okay. Because yeah, the economy is okay. People have jobs. Markets are still high. Asset prices are still high. People are still spending. Businesses are spending. The government's spending. So this is the time for you to be preparing and understanding that, hey, there's a lot of money out there. Money markets have more money than really ever. Or no, not really ever, than ever before. I recently put a video out about that. So people still have money sitting on the sidelines. And as you start to see that money on the sidelines start to go down, as you start to see consumer spending start to slow down, that's when you would see a shift in the economy. But it's not trying to time that. It's not trying to predict that, but rather understand that. That way you can be financially smart and understanding this is the time. 2023 is the time for you to get financially smart. That way you can be ready for whatever's coming in the years ahead. Notice how it didn't just say 2024, but the years ahead. Because, well, no one can predict what's going to happen tomorrow, next year, the year after that, but you can be prepared for whatever might be coming ahead, and that's why 2023 is the year for you to get financially smart. And don't use what's happening in the traditional media as a reason to panic and make rash financial decisions to either buy or sell. Nobody ever makes good financial decisions that way, ever, in the history of time, but rather understand what's happening, be financially educated, work to get prepared. That way when you see opportunities, you can pounce on them, but you have to have the financial education and you have to be prepared, because you can see the best investment opportunity in the world. But if you don't have any money to capitalize on it, it doesn't do you any good. Just like that, you can have the money to invest, but if you don't see the opportunity, well, that doesn't do you any good either. This is some of the things I'm going to be talking about in the Investor Summit, but this is why I keep saying 2023 is not the year for you to go out and finance a new truck. It's so you use this time as a time to get financially educated when times are okay.